Guaranteed investment certificates, or as they're more commonly called, GICs, can be found in section 3.1.6 of your book. As always, before we dive in, we're going to get into those three really important things that will help you differentiate GICs from all the other types of investments you're learning in segregated funds, and also really remember what GICs are. And those three things are safest investment, many options, and simple to understand. These will become clear as we get into it. So GICs are really all about the safety of capital. That means that your initial investment or your principal that is put into the GIC, you get back at the end of the term. And that is part of that guarantee. Now, terms are available up to 10 years, but really people are mainly investing between 2 to 5 years in a GIC. And what is a GIC? It is a loan from the investor to the issuer. So a loan is given, and that could be a company, insurance company, a bank, and this company is guaranteeing that they will return your investments, your initial principal, plus a set interest rate. So you know what your return is, what money you're getting back at the end of that term, so that 1 to 10 years, you know exactly what you're going to get back. Now, GICs can be purchased from a variety of places: a bank, a trust, an insurance company, or a credit union. And the people who actually are selling them, either an investment dealer or you as an insurance advisor. Now, there are some benefits affiliated with who you purchase from. So if you purchase from an insurance advisor, you get that insurance company benefit. So insurance companies classify GICs as an investment product, and so you get to bypass probate, and you do also have some creditor protection. So this is really a huge benefit that you have as an advisor. So bypassing probate allows your client to skip those fees, and creditor protection protects that money. Now, in order for this to actually be effective, or these protections to be in place, it is so important that your client has a named beneficiary. We're going to go through the types of GICs. We're going to start off with the most popular for Canadians, which is the fixed interest. Really, people are going into GICs because they know what the interest rate is. The next is cashable or redeemable, which is really what the name says. You get access to your money as you need it. However, there is a lower rate of 25 to 50 basis points as a result. Escalating, which means that it does keep up with the interest rate. Variable, which is not so popular. Typically people are getting into GICs not for variable interest rate. Market linked, which follows the stock market up and down, so there are some fluctuations in that one. And foreign currency. With foreign currency, there is no CDIC or assurance that protection that Canadian money does have. There are two risks, which are really big ones actually. Inflation, which means your purchasing power is eroded. So if you invest, you get 3.5, but inflation is 3, then you're really only getting 0.5 back, and your growth is eroded. And interest rate. As the interest rates increase in the outside market, your interest rate in your GIC is not increasing if you don't choose one that is. Now, there are two types of investor protection depending on where you buy it from. CDIC, or Assurus, and either way, that coverage that you get is $100K. Advantages and disadvantages. A lot of these you've probably already heard through this presentation. So first, guaranteed return of principal and interest. So all your money comes back to you, and you know exactly what interest rate you're getting. There's a huge variety, as we just saw, and there's really something for everybody. Minimum investment of only $500. So people can really get into this at a very low rate. It's great for people who are just sort of trying to get their feet wet or just learning about investing in the market. No fees. And same thing, simple. So what you see is what you get. Same thing as just saying, great for new investors. It really simple to understand. They don't have a lot of trouble knowing what's going on. Disadvantages. So there are low returns or interest rates. With that guarantee, you do have to sort of quote unquote pay for it by getting a little bit of a lower interest rate or a low return. Your interest is fully taxed as interest, so there is no break there, and there are penalties for early withdrawal. So if you put your money in for 2 years and you need to take it out after 1, you are going to have to pay some fees. So it's really important when you get into a GIC to really understand that there are penalties for early withdrawal.